You'd think that with the S&P doing well this week and a great May, investors are bullish. They are not. In our calls and Zooms with portfolio managers, many are still cautious because they see tariff risks ahead and they don't have tariff resolution in hand and they can't get bullish. I think the feedback we get from a lot of folks is they think stocks shouldn't be rising. So I would say, given the amount of cash on the sidelines, the fact that short interest is going up, and we have a quiet week and markets are rallying, I think the risk is now of a substantial leg up rally from here.
Tom Lee highlights a noticeable disconnect in the current market environment. Despite a strong rally in the S&P 500, investor sentiment remains surprisingly cautious. In his frequent conversations with institutional portfolio managers, Lee observes that the prevailing mood is far from euphoric. Instead, many investors remain fixated on unresolved risks that continue to weigh on their outlook, chief among them the potential for new tariffs. This persistent focus on downside risks is tempering optimism, even as market performance suggests otherwise. Now is the perfect time to hit that subscribe button. Your support helps the channel grow. Thank you.
You'd think that with the S&P doing well this week and a great May, investors are bullish. They are not. In our calls and Zooms with portfolio managers, many are still cautious because they see tariff risks ahead and they don't have tariff resolution in hand and they can't get bullish. I think the feedback we get from a lot of folks is they think stocks shouldn't be rising. So I would say, given the amount of cash on the sidelines, the fact that short interest is going up, and we have a quiet week and markets are rallying, I think the risk is now of a substantial leg up rally from here.
What role do tariffs play in all of the way you're thinking about the market?
Well, tariffs matter. Remember, before February, before Trump sort of talked about this, the base case for many was a 15% tariff. Let's say that we're going to end up at a 10%. That's 10% on 15%, which is imports, which is about a 1% GDP effect. That's not that different than oil going from 40 to 80. And we wouldn't say $80 oil breaks the economy anymore. So I think tariffs we have to adjust to it, but it's not the thing that takes us to 4,000 S&P anymore.
Now, what if there's a renewed and more protracted, if not dug in fight over the tax bill? What if Musk's post on social media earlier is enough to get some lawmakers in a very thin margin Washington to rethink their positions based on his political donations or lack of support in the future? Is that a real concern in any way?
Well, this is what's going to be set up as what I'd call event risk. And it's an event risk similar to a government shutdown or an auto plant shutdown, something that affects the economy for a specific period of time. But again, those have not been things to turn structurally bearish. They may be tactical risks, but again, they've always been buy the dip opportunities.
So if, for argument's sake, the tax bill ends up not as big as the price tag is on it now, would that be a positive taken by the market? Maybe the bond market would feel pretty good about that, wouldn't it?
Yeah. I mean, Scott, it's kind of hard to say because I could see it being if bonds rally, that's good for equities. But if this tax bill leads to more spending, even if yields rise, markets are going to focus on the earnings effect. So I'm just going to say it could go either way. I mean, it could be bad or it could be good.
When you hear Jamie Dimon talk about there will be cracks in the bond market, do you just brush that off as that, I would expect someone in Jamie's position to be talking about the risks that are in the system? Or do you sit back and say, well, maybe that first little scream from the bond market was before there's a full-on tantrum, which wouldn't be good for equities in any way?
Well, JP Morgan has a dashboard to the U.S. economy because they see consumer credit. They see it real time. We know consumer credit delinquencies are rising and auto loan delinquencies are rising. But is that going to spill over into the broader credit market to create a credit event? The one market we watch is high yield. High yield spreads have actually managed to hold on to most of the rally gains, and they've retraced 70% of the widening. That's a market that says the economy actually is starting to strengthen.
So you don't put that much cred into bigger worries about the bond market having an issue anytime soon. And even for accuracy's sake, I mean, it's not like he said we're going to have this issue tomorrow. I don't know if it's 6 weeks, 6 months, 6 years. I'm paraphrasing, but that's generally what he said.
Yeah. I mean, I think Jamie's flagging that there are parts of the economy that are weak, including housing. I mean, housing is deteriorating very quickly, but that's also going to deliver a pretty big deflationary pulse. That was 75% of the rise in inflation since 2019 is housing and auto services. So if housing is turning down on price because there's supply, I would argue that's a structural decline in inflation. The Fed would actually have to be quite dovish in the next 12 months. That's bullish.
Lee highlights a key macro trend, the return of the bond vigilantes. While not actual individuals, this term refers to bond investors collectively pushing for higher yields to offset rising risks, whether from inflation, growing fiscal deficits, or political uncertainty. These investors haven't forgotten 2022, when bond prices plunged as yields surged. As a result, they're hesitant to buy long-term treasuries at current levels without adequate protection. Check out James Lavish's Insights. They offer valuable perspectives on the current market landscape and macro trends.
The highest rating in debt is AAA. Mm-hmm. That's prime, right? And so the U.S. was always, it's the global reserve asset, right? The U.S. Treasury. And
you surely can't get better debt.
Surely you can't get better debt. Like, this is riskless. Like, this is supposedly the 10-year U.S. Treasury is supposed to be riskless.
Yeah.
That's the point. Well, then we had a couple of things happen, and one of them was a budget battle. And I believe it was S&P that downgraded them first, if I remember correctly. And
just S&P obviously is not the actual S&P. That's Standard &
Poor's. It's Standard & Poor's. It's the same company. It's just that this is a different, area, different division.
This is that, yeah.
So they downgraded, not because they think that the U.S. is going to default and not pay the bonds. So this is where people get a little bit tripped up. AAA is like, there's no risk whatsoever that you're ever going to default, right? Then you've got AA, which is, it's like as close to AAA as you can be, obviously, but there's something there. Okay. So why would they downgrade the U.S. if they're never going to default, really? And even when they did default because of this budget battle, it was back in, I want to go back and, I've got the newsletter here, so I don't want to quote the wrong time frame, but it was, 1979 is when they technically defaulted. So what happened? So they were in this budget battle, and back in 1979, everything was done by paper, right? So they're in this battle, and the congressmen are going back and forth. They're fighting about it. They didn't want to raise the debt ceiling. Finally, they get to a solution and they raise it, but it was at like the midnight hour, and it didn't give the Treasury enough time to stamp the envelopes and get them out the door with their interest payments. Huh. And so they tripped a payment, and they made it up really quickly. They made everybody whole, but technically they defaulted. So that's what we're talking about here. Because, Lynn talks about all the time is like, if you're a sovereign that issues debt in your own currency, you would never default. You'll just print more currency and buy the debt to make sure that you're not defaulting.
Yeah.
And so, but the technical default is that you trip a payment and then you make everybody whole later, which is what happened in 79. So
no one you were actually not defaulting on the debt for anyone. That's just like the fact that it was politicking for too long. They decided to raise the debt ceiling too late and they missed a payment, then made it up.
Right.
Okay.
Right. And then back in 2011, it's the same kind of thing happened. That's when S&P, so it was Fitch who did it first, and S&P did it.
Did what?
No, I'm sorry. S&P had downgraded the U.S. first
in 2011 after the financial crisis.
And yes, in 2011. Then 2023 is when Fitch joined them.
Okay.
Yeah. But why does that matter? And why do you see that? So you see bond investors get worried about this. And how do you know that they're worried? Well, you see term premium. You see premiums that meaning that the debt trades at a higher yield than it normally would. Because you can calculate it out. The term premiums are somewhere around 80 basis points or 90 basis points right now for the 10-year. It should be higher, but we'll get to that in a second. But the reason that you have that is because investors are concerned about inflation, and just this deluge of debt, who's going to buy all of it, which means that they want to be compensated for that deluge of debt that's coming. We're seeing that people are a little bit worried about inflation, which gets us to stagflation. We can talk about that in a minute, but the people are concerned about that. Investors are concerned about that. And bond investors are like, they don't want to buy 10-year, 20-year, 30-year treasuries and have what happened back in 2022 all over again, where, interest rates go up, the bond is worth less, and they're sitting on this portfolio of marks that are, down 20, 30% again.
Yeah.
So how do they compensate themselves and protect themselves? Well, they demand a higher rate. And this is where the bond vigilantes come in. Bond vigilantes are the ones who are saying, no way. And it's not like a group of, it's just that investors are looking around. Yeah, they're looking around. They're saying, yeah, we need a higher rate here.
Yeah.
And they're not colluding, but they're recognizing each other like, yeah, I need a higher rate too.
Everyone's seeing the same thing.
Right. So then you get this term premium. And the last piece of that, so you've got inflation, worry about interest rate risk, concern of interest rate risk because of, both inflation and because of the deluge of debt that we know is coming. I love Doge. It's great that they're getting rid of fat and, and fraud, but they're not going to balance the budget.
Of course.
It's just not going to happen.
That seems more clear than ever right now.
You're right. I mean, I've been saying this for since the start. It's like, it's too much. The math is not going to work. So, but that's fine. The issue here is that the last part of that is now you've got this deeply divided political faction, right? So you've got the Democrats and the Republicans they almost can't even, they can't even speak. Like it used to be back in, the 80s at least, and the 90s, they could at least talk across the aisle and really, kind of be reasonable. Totally,
that's out the window.
Irrational. Like they're totally unreasonable between the two parties now. So that means that each party is trying to trick the other one into making cuts into their programs to hurt their constituents to get fewer votes. We know that. It's the way it works. But the issue here is that they're so entrenched in the battle that the risk is that we go right up against that window again. It closes and we trip a payment. Of course, they'll make it up, and they will make everybody whole, and they won't fully default. It'll be a technical default. Then why do the credit default swaps on the U.S. bonds start to get more expensive?
James Lavish concludes by addressing the deepening political divide in Washington, where bipartisan cooperation has nearly vanished. Instead of working together to address structural problems, both parties focus on assigning blame. As a result, future budget negotiations are likely to be tense and drawn out. This ongoing dysfunction raises the risk of technical defaults, drives up credit default swap pricing, and adds to bond market volatility. If you found this valuable, please like the video and subscribe to the channel. Thanks for watching. Now click on this video to keep learning.